Brexit and gold. March 2019 approaches and an exit deal is far from complete. The UK is set to exit the EU, and the prospects of a deal are as gloomy as ever. Here's how a messy 2019 Brexit could affect the price of gold. After the Salzburg summit, the prospects of the Brexit deal are gloomy as never before. Will gold gain on failed talks between the EU and the UK? Cake philosophy and gold. The Salzburg summit was held last week. It was an informal summit of heads of the EU member states or governments. The participants discussed immigration, internal security and Brexit. The negotiations between the UK and the EU attracted the most attention, as Donald Tusk, the European Council president, said that the Chequers plan for Brexit will not work, and mocked Theresa May's negotiating strategy in social media. He posted a picture of May and himself at a cake stand with the caption, "A piece of cake, perhaps. Sorry, no cherries." May did not like the joke and accused the EU of the lack of respect. She also complained that the EU does not want to negotiate with the UK. But it is not true. 1 year ago, the United Kingdom rejected the proposal that the UK would become a member of the European Economic Area and be associated with the common bloc as Norway or Iceland. May rejected the Norway model, saying that it would be a mockery of the referendum. And 6 months ago, UK rejected another proposal for an EU trade agreement, i.e. access to the single market, along with Northern Ireland, so that there would be no physical border in Ireland. May rejected the second proposal, saying that it would effectively divide the country. And last week, the British Prime Minister said that the UK wants to participate only in the free movement of goods, without the free movement of services, capital, and people. It is understandable, as about half of the UK exports is going to member countries. However, the EU has been informing for a year that it will not agree to partial access to its market, as it is based on 4 freedoms, not merely 1. There is no cherry picking. We are not big fans of the US bureaucracy, but we agree that you cannot have the cake and eat it. The UK can either have a loose agreement, like Canada, or a close agreement, like Norway, but it cannot pick the best bits from both. Implications for gold. What does it all mean for the gold market? Well, we do not see a compromise in Brexit talks on the horizon. The British officials live under the illusion, and both sides are standing still. If nothing changes, the UK will exit the EU, without the deal on March the 29th, 2019. The EU law will no longer apply in the UK. The millions of Europeans working in the UK will need to have permission to work. There will be custom duties for goods. For example, the tariff for food imports will increase from 0 to 22%, disrupting the trade chains. Britain would fall out of EU regulatory bodies for things like air safety, medicines, or nuclear materials. So if it does not create own regulations on time, the airplanes might be grounded, while some medicines and isotopes might not be imported. And there could be even a hard border on the island of Ireland. Moreover, there will be no continuity of financial business, as British companies will lose their passports, allowing them to sell services and products across the bloc under London's regulations. It is difficult to predict all repercussions, but one thing is certain: there will be a lot of uncertainty and temporary disruptions. We wrote temporary, as there is also life outside the EU, and the UK is one of the most developed economies, after all. The exit is likely to be disorderly. The price of gold expressed in British pounds should rise then. The impact on US dollar-denominated price is not so clear. After the surprising outcome of the referendum, the international price of gold soared, as one can see in the chart below. But where two are fighting, the third wins. Hence, the greenback should take advantage on the divorce between EU and the UK. It could limit the possible gains in the gold prices. Please remember that the EU will be weaker without the UK and its financial contribution to the common budget. We will see. A lot may still happen in that Brexit saga. Now, all eyes are on the FOMC September meeting, which could affect the gold market. The meeting will end on Wednesday, and we will cover it on Thursday. If you enjoyed the above analysis, we invite you to check out our other services. We provide detailed fundamental analyses of the gold market in our monthly market overview reports, and we provide daily gold and silver trading alerts with clear buy and sell signals. If you're not ready to subscribe yet and are not on our gold mailing list yet, we urge you to sign up. It is free, and if you don't like it, you can easily unsubscribe. Sign up today. Disclaimer: please note that the aim of the above analysis is to discuss the likely long-term impact of the featured phenomenon on the price of gold, and this analysis does not indicate, nor does it aim to do so, whether gold is likely to move higher or lower in the short or medium term. In order to determine the latter, many additional factors need to be considered, and we are taking them into account and discussing the short and medium-term outlook in our trading alerts. Gold prices slip as dollar firms ahead of Fed rate decision. Fed rate hike widely expected. Spot palladium moves away from 8-month highs hit on Tuesday. Gold prices fell on Wednesday as the dollar strengthened ahead of the results of a Federal Reserve meeting later in the day that is expected to raise U.S. interest rates and hint at the outlook for future rate increases. Gold is sensitive to higher interest rates because they tend to boost the dollar, making gold more expensive for buyers with other currencies. They also push up U.S. bond yields, reducing the attraction of non-yielding bullion. A Fed rate hike, the third this year, in an announcement is anticipated, and is therefore unlikely to shift gold prices, said Forex.com analyst Fawad Razazadeh. Markets will instead be looking to the Fed's economic and interest rate projections and a news conference by Chairman Jerome Powell for something to move gold from its recent trading range of $1,190 to $1,210 an ounce. If the Fed appears more dovish than expected, we may see a breakout for gold, Razazadeh said, adding that without a surprise, gold was unlikely to move much. If we break technical resistance at $1,205 to $1,215, at a minimum we could go to $1,240, he said. Spot gold was down 0.5% at $1,195.04 an ounce, remaining close to a 19-month low of $1,159.96. Reached last month. U.S. gold futures were also 0.5% lower at $1,199.10 an ounce. Gold has fallen more than 12% from an April high, as a vibrant U.S. economy, expectations of higher U.S. interest rates and fears of a global trade war have caused the dollar to rally. Investors looking for a safe place to park assets have preferred the U.S. currency bullion, undermining gold's traditional role as a safe haven, while speculators have ramped up bets that gold prices will fall. The greenback was slightly stronger on Wednesday against a basket of major currencies, and is up more than 5% since April. Analysts at Commerzbank said gold was stuck beneath technical resistance at its 55-day moving average at $1,207.76 and its 4-month downtrend at $1,220. They said prices would likely move lower and that their long-term outlook had become more negative since gold broke below its 2005 to 2018 uptrend line, now around $1,215. In other precious metals, silver was down 0.4% at $14.36 an ounce after touching a 3-week high on Tuesday. Platinum had gained 0.2% to $824.20 an ounce, and palladium was unchanged at $1,060.97 an ounce, near an 8-month high of $1,068.50 reached in the previous session. Theoretical basis of fundamental gold price calculation: precious metals supply and demand. Speculators versus arbitrageurs. The price of gold rose $6 and the price of silver rose 26 cents last week. Before we look at the graphs, we want to address a reader question. This week, someone asked about how we calculate the monetary metals fundamental gold price. The theoretical fundamental gold price versus the market price for gold since late 2015. Worth noting, most of the time, the fundamental price is leading the market price. Whenever the gap between the two prices was very large in the past, the market price would more often than not catch up with the fundamental price. Recent exceptions to this rule of thumb occurred in mid and late 2016, when market prices first rose and then fell, and the fundamental price followed their lead, and again this year, when a big surge in the fundamental price failed to lead to a rally in market prices. However, on this occasion the fundamental price corrected quite sharply before an accelerated decline in market prices took hold. Since early July, the gap between these two prices has gradually widened again, and has become quite sizable. It remains to be seen whether the fundamental price will work as a leading indicator this time. As noted above, in the long term it tends to lead in most cases. This is the output of our model, estimating where the metal would be trading if not for speculators who can push the price around, using extreme leverage in the futures markets. While the formula must remain a trade secret and we may upgrade it in the next version of our data science platform, we are happy to discuss the theory. Every week, we show a graph of the gold basis as our picture of the fundamentals. What does this mean, and how is basis showing the fundamental situation? The basis is the spread between the spot and futures price. It measured as the actionable trade, future, spot, which is the profit that a bank or hedge fund could make. And it is expressed as an annualized percentage, so it is comparable to the interest rate or yield on other assets for the same duration. This shows the fundamentals for a compelling but counterintuitive exercise in reasoning. Arbitrage connects the price of an ounce in the futures market with the price of an ounce in the spot market. They track very closely, and the difference between them, i.e., the basis, is usually small and pretty stable. If we see the basis rising, we know that arbitrageurs are putting on more carry trades. Carry means buying physical gold at spot, selling it forward, and warehousing it in the meantime. The higher the basis, the more profitable it is to engage in this carry trade. We don't know how many carry trades are on, but we do know that if the marginal arbitrager walked away yesterday when the basis was, say, 0.5%, then he may take it today, if the basis is 0.6%. A rising basis indicates metal is moving into warehouses. A rising basis means that the marginal demand for metal is to carry it in the warehouse. While there could be continued momentum, this is generally not a bullish sign. The basis is rising despite this arbitrage. We say despite because this arbitrage compresses the basis spread. If it is rising, it shows that speculators are buying faster than arbitrageurs are adding to their carry trades. The former are bidding up the futures price, while the arbitrageurs are pulling the spot price up behind it. This metal will come out of the warehouses and back into the market at some point. Alternatively, if the price of gold is rising and the basis is falling, then we can be sure that fewer carry trades are being put on. The rising price is driven by buyers of spot gold. If the warehouse men are active, they may be selling spot and buying futures, i.e., closing out their carry trades. Our model watches the action from all angles in order to calculate a neutral price. This is the price at which spot is not pulled up or pushed down by this arbitrage activity. It is not perfect, the calculation is in part art and in part science. And of course, the market is always changing to boot. There are times when we can't see a price move counter to the fundamentals, and in due course the price reverses back to where it was. It is often tempting to say we told you so. But lest we put on our hubris t-shirts, there are other times when the market price moves and the fundamentals later catch up or down to market prices. It could be that the speculators were right and knew what was to come, or it could be that holders of physical metal reacted to the change in prices by buying or selling. Stay sharp. Fundamental developments. We will look at the supply and demand fundamentals of both metals. But first, here is the chart of the prices of gold and silver. Gold and silver priced in USD. Next, this is a graph of the gold price measured in silver, otherwise known as the gold to silver ratio. It turned and fell last week, gold-silver ratio. Here is the gold graph showing gold basis, co-basis, and the price of the dollar in terms of gold. Gold basis, co-basis, and the USD priced in milligrams of gold. Not a big move in price, but the dollar is down, while the scarcity of gold is rising. At least it does in the December contract. The continuous gold basis chart shows a falling co-basis. Last week the monetary metals gold fundamental price fell from $1,373 to $1,358. Now let's look at silver. Silver basis, co-basis, and the USD priced in grams of silver. In silver, the price rose by a greater percentage, and the co-basis is falling even for the December contract. As one might say, this is not the signal you're looking for. Nevertheless, the monetary metals silver fundamental price did rise by 13 cents to $15.94. Let us see if it holds around the $16 level.